Hello everyone. So welcome to one more video on inventory valuation, and on this we are seeing the different methods. So one is the average cost method. We have already solved that problem here. Now taking the same example, I'll do it now in the first in first out principle or FIFO method. Now what we are doing here is the company Davidson Electronics had an inventory on January 1st of 5,000, purchased 15,000 on April 2nd, purchased 20,000. Now at different costs. Now it has 7,000 units on hand at December 31. Now which are these 7,000 units? Are these 7,000 units which were at the original inventory, or the last one recently purchased, August 28th? So in the FIFO principle, what it says is first in, first out. That means you will sell the inventory which was first you purchased. That means the 5,000 inventory is sold, 15,000 inventory is sold. Only after that you will start selling the 20,000 inventory. So first in, first out is something like, if you consider it as a pipe. So in this, whatever enters into the pipe, so first that will have to go out. Okay, so what was the first entered into the pipe? So here I will just make some circles. Okay, so this is the inventory purchased on Jan 1st. Okay, and 5,000 units and cost of $8. Next, the items that were purchased were on April 2nd, and then 15,000 units, and then the cost was $10. And then next, the items purchased were on August 28, and there are 20,000 items, and the cost was $12. Now which one entered the first? This is the first, this is the second, and this is the last. So first in, first out, that means these are sold. So how many are sold? Balance inventory is only 7,000. That means all these are sold, only out of this 7,000 are remaining. So you simply start from the bottom and take the unit cost. Okay, so cost units in ending inventory. So is 7,000. Okay, so then so out of 20,000, 7,000 is less than that. So therefore you can directly take cost of ending inventory simply is 7,000 multiplied by 12. So you will get 7 into 12, $84,000. Okay. So the cost of ending inventory is 84,000. Earlier, what was the cost of ending inventory? The cost of ending inventory was 75,000. So now it increased from 75,250, it increased to 84,000. Okay, so the cost of inventory has increased. Okay. So at the same time, so now if you want to say cost of goods sold, okay, cost of goods sold, here you simply take the total cost of inventory, that is 430,000 minus 84,000. So then you will get the cost of goods sold. So 430 minus 84, so $346,000 is the cost of goods sold. Whereas here, if you see, the cost of goods sold is less. So here cost of goods sold is more. Okay, so like that it will be the different. Okay, now let's do last in, first out. Okay, so if you go for Lifo, last in, first out, so which was the recent one? This 20,000. This is the last in. So this is already sold. This is sold, like that. So what is left in the inventory? 7,000 units. But here 5,000 units are costing $8. 7,000 is more. So out of those 7,000, the first 5,000 will be at $8. Okay, so here cost of ending inventory. So cost of ending inventory, what I'll get will be 5,000 at $8 plus 2,000 at what was the next group, 15,000. In that, out of this 15,000, 2,000 will be retained and remaining 13,000 are sold and remaining 20,000 are sold. So only $10 here into 10. So here 8 into 5 is 40,000 plus 20,000. So that is 60,000 is the cost of the ending inventory. Okay. So therefore, what is the cost of goods sold, COGS? So cost of goods sold will be 43,000 minus 60,000. So we'll get 430 minus 60. So $370. Okay, so like that. So let's compare. Okay, so what we are comparing is cost of ending inventory cost of goods sold. So what are the three methods? So first method is FIFO method, first in first out. Next method is average cost method and Lifo method. Okay, so why I kept average in middle is that the answer will be in the middle of these two. Okay, so you see for the Lifo method 60,000 is the cost of ending inventory, whereas in the FIFO method the cost of ending inventory is 84,000, and whereas the average cost method the cost of ending inventory is 75,250. So now you can see this is high, this is next higher, and this is lower. So for the same amount of inventory, you are getting different results. So obviously the cost is changing. So if the cost is more, profit will be less. And if the profit, whereas if the cost is less, the profit will be more. So you may think that okay, profit is more, so let us go with Lifo principle. But then if your profit is more, income tax will be more. Okay, so it is not always that you have to go for one method or the other. It is a company decision. Similarly, cost of goods sold, here it is 370, whereas in the average cost method it was 354, 750, whereas in the here it is 346. So here the trend is reverse. Okay. So by the way, all this analysis holds good when there is a inflation. That means when there is a continuous trend of increasing cost. So 8, 10 to 12 like that. Anyway, I think we will end this video here, and we'll take up one more example problem of the similar kind, and we will try to solve it. Thank you. If you like this video, please press the like button, and please share this with your friends. We are making this playlist on inventory valuation, and we finished the LCM method and ending inventory calculation. We finished all three methods, but we will try one more problem on this. Thank you.